So I'm wiping the word retirement out of my vocabulary because that's, again, got to be one of the stupidest ideas that ever came along. People got to get that out of their minds. That idea of retirement does not appear in the vocabulary of human beings until 1890. That wasn't all that long ago. My father was born in 1897. Bismarck, Germany, socialist. The whole idea was to get those old folks out of the workforce to make room for the young folks because not all that many jobs to go around. All right, so they came up with this idea and it stuck in people's minds. And so everywhere you go within the life insurance industry, they talk about retirement. That reminds me of something here that we have not covered. We'll go back to Iacocca in his book. He said he learned that you don't make money designing cars. You don't make money building cars. You don't make money selling cars. You make money financing cars.
That is the truth.
Yes.
And I've also heard, just for trivia, I've heard Bill Gates say, our business was not to manufacture the vehicles, but rather to provide the fuel for the vehicles.
Right.
So they didn't get into the computer business. They provided the software or the fuel to run the computer.
Yeah, over a period of time in the airplane world, the cost of the airplane cost is spectacular, but you consider the fuel during that period of time, and guess what? There's all kind of funny stories out there when people think about them, about the guy sitting at the window and they're fueling up the airplane to the little yellow truck and so forth. And they flew to the destination about 2 hours away, and the guy looks out there and there's that same yellow truck. He said, man, that truck is fast, isn't it?
Speaking of funny stories, Nelson, you shared a story with us, and it involved a Martian.
That's further in the exercise of the equipment financing. So first thing we got to do is describe the vehicle out there. We got to get the line in the sand. This is the vehicle we're going to operate from. And so the person put in the $40,000.
Yes.
Yeah. Well, for the size of the operation that we're talking about, that's common.
Right.
Very, very common. All right, so he put $40,000 in there for 4 years. So he's got an outlay of $160,000 at the end of 4 years. Yes, but you notice that the cash value of the policy at that time was $157. They're almost dollar for dollar.
Right.
Now, as time went by there, when we get the dividends are engineered to get better as time goes by. I can prove that very easily by actual experience of a state farm policy that I bought back in 1959. It's engineered to get better as time goes by. And so the dividend paid the premium, and the surplus bought additional paid-up insurance and whatnot. When you get on that about year 17, I believe it is, best I remember, the dividend now exceeds the premium, the base premium.
That's correct.
What happened after the $40,000 per year for 4 years is that he terminated the paid-up insurance rider, and the base premiums got to be paid till age 65. And again, I would never recommend that somebody use age 65 necessarily. I just want to cater to the minds of those people that their minds are locked and so forth, so that they don't have any premiums to pay after 65.
So you're meeting people where they're at.
I'm meeting where they are and catering to them. I would never actually do it that way, but we're talking about principles here, and that is all. Well, when we got down there to age 65, he's had an outlay, a total of $160,000. But tell me, what's the cash value at that particular point?
It is $1,517,320.
Now, that's the cash value?
Yes.
Yes, all right. He decides that he wants passive income now. So I'm wiping the word retirement out of my vocabulary because that's, again, got to be one of the stupidest ideas that ever came along. People got to get that out of their minds. That idea of retirement does not appear in the vocabulary of human beings until 1890. That wasn't all that long ago. My father was born in 1897. Bismarck, Germany, socialist. The whole idea was to get those old folks out of the workforce to make room for the young folks because there's just not all that many jobs to go around. All right, so they came up with this idea, and it stuck in people's minds. And so everywhere you go within the life insurance industry, they talk about retirement, retirement. I've wiped that word out of my vocabulary, and I just call it passive income. That's money coming in, and you can't help it. It just shows up. So he decides that at age 65, he wants to start drawing out $90,000 a year. Wasn't that right?
92,000 a year.
92,000 a year. Well, you notice that he recovers everything he put in the policy in what, 4 years or 5 years?
That is correct.
That is all. From that point on, he has recovered everything he put in the policy. And from that point on, we have loans, right, don't we? Now, those loans are increasing, but the cash value is increasing bigger. Well, what happened at his age 85? Please tell me.
Well, at age 85, he had been able to draw a passive income of $1,748,000.
Yes, sir, but what is the death benefit?
The death benefit is $2,407,736.
What was it at age 65?
$2,406,948.
Almost the same.
Almost the same.
Now, how did I come up with those numbers? And this is when I had to teach people artillery. I know the dividend is engineered to get better as time goes by. And so let's look at the dividend at his age 66. What is that dividend?
That dividend is $76,620.
But yet he drew out $92,000.
Right.
Well, where did that come from? He surrendered some additional paid-up insurance. Now, the dividend's engineered to get better, so what happened the next year?
The dividend got better.
Yeah, and so we didn't have to surrender quite as much, did we? Now, when we get down there to a certain point, we got an equilibrium point there, don't we?
Yes, we do.
What year is that?
Age 76, so that's start of year 47.
Yeah, all right, we got an equilibrium at that point. All right, then what happens from that point on?
The dividend keeps getting better.
Yeah.
Death benefit begins to increase.
Yes. And so all I wanted to do was just to find a constant income that would be pretty well guaranteed and still have a death benefit at age 65 and age 85. Now, how did I do that? Again, I had to teach people artillery. Not too many people have been through artillery school, Fort Sill, Oklahoma. About 12 miles away is a battery of 155 millimeter cannons. That's 6 of them. Now, out here where the action is, a expendable guy called a second lieutenant, and he's all camouflaged, and he has field glasses, he has a compass, he has a radio, and he sees a target out there that he wants to get rid of. Well, that field glasses has a scale on it, vertical and horizontal, and he's been through Fort Sill and graduated, so forth, so he can pretty well estimate where that target is on the grid coordinates. All right, so he calls back to the fire director at the where the cannons are and gives that coordinates. Says, now one of you guys throw a white phosphorus shell out here to these grid coordinates. Now that white phosphorus shell has no explosive ability. It's a white puff of smoke that's more easily seen than a shell. Now he gives him a 10-second countdown. 10, 9, 8, 1, boom, splash rather. All right, the shell looked like it landed about 50 yards short of the target. He does not have a scale. That's just his estimate. So he calls back and says, same guy, chunk another one out there. Add 100, splash. Went over the target, about 50 yards. He's got a yardstick now, doesn't he?
Yes.
Drop 50 and fire for effect. All 6 cut loose with the high explosives, and there goes the target. I knew that the dividend is projected to get better. Look at the dividend at age 66 again.
Yes.
All right, what is it?
76,620.
Now go down about 7 lines.
86,348.
So I said, let's try an income of 100,000 a year. And I ran the projection, and the numbers started going down on the right-hand side of the page.
Okay.
That didn't meet my criteria. It had nothing to do with the insurance company at all.
Right.
What I wanted to produce. Well, I didn't want to eat into that death benefit that would ultimately manifest itself. So I said, let's try 80,000 or something like that. And when I did, the numbers on the right side of the page kept getting bigger. So I just closed in on it. That was all just like the artillery man. There's nothing. This is ridiculously simple.
Such a wonderful analogy.
It's just that people don't think this way.
Right.
Yeah.
And you've taught us that everything begins with the way that we think.
It's all about it. Yeah.
You've also said that engineers overbuild everything and that the actuary at an insurance company is in fact an engineer, so to speak.
Sure. He overbuilds whatever he's doing out there. Yeah. That everything that you do out there involves that kind of thought process. That I've been an airplane driver now for 71 years. Never seen an airplane that didn't have an airspeed indicator. Never seen an airspeed indicator that did not have a red mark on the airspeed. It says, don't go past here, the airplane will come apart on you. Lie, it doesn't. He put a fudge factor in there.
Right.
It won't come apart till you get to about 120. If 100 is where the red mark is, it won't come apart till you get about 120. But if you always within that envelope of 100 plus, you're putting stresses on the airplane that are cumulative. One of these days it'll pay off and it won't be a pretty picture.
Right.
The only good part is you don't have to hunt very far for the parts of the airplane.
On page 57 of your book, you say, at this point, we turn to the matter of ownership of the policy. Could you expand for us on your remarks in the book that the corporation itself should not own it?
Yeah, there again, we enter the CPA mindset, so forth. So many of the times back there in when I was in the insurance business, it's easier to find businesses that would use corporate dollars to buy life insurance and make the corporation owner of it. And that is grossly wrong. They ought to think exactly opposite. You want to own the bank and you want to have a captive customer that you can sock it to in big time. It's ideal, but this doesn't occur to people out there because that's not what they're taught.
Now, you also go on to say on page 58 that actually this interest is not really interest. It is additional premium or capital that has been paid into the policy.
Yeah, I'm just talking about cash flow there that is equal to interest, whatever. What it amounts to is that there's certain things in those illustrations you cannot see because it would require 3 more columns. And we've already got too many columns because people get intimidated by all those numbers.
Right.
But that's not the intention of the illustration. The illustration is to just show you what is happening to the level that you can comprehend fairly easily. I didn't say easily, I said fairly easily. But the interest that is illustrated there is really premium. But cash flow is cash flow is cash flow. What's actually been the interest is surrender of dividends, which I would never advise anybody to do. So, but we got to find some way to tickle their imagination. And so I point out that here's my nephew, Terry, the logger. He has 4 trucks, 2 Caterpillar tractors, and a tree shear. And every last bit of those things are financed. $1,502 a month, yeah. For one tractor, right. For one tractor, $1,502, yeah. But he has 4 of them. Plus, the tractors are twice as costly as the trucks, and the tree shear probably costs $500,000 or so. But he's got a stripped down model. I believe his is only about $250,000 or so. And all those things are financed, and so he's paying all this money to the finance company, and so much of it is interest that it's kind of mind-boggling when you think about it.
Well, and if you compare page 54 to page 59, Terry made $500,000 just by shopping at home.
Just by shopping on for one truck.
He took the energy away from the outside finance institution and he put that energy into his own.
Yeah. He says, what if I could finance 2? And so we ran the figures there, and he picked up another $500,000 tax-free.
You've also said that banks can do anything they want to do if they have the capacity.
At the capacity, yeah, of course.
And so that would be a natural response if he says, listen, can I run another truck through this policy?
Yeah.
Well, banks can do anything that they want to do if they have the capacity, and he clearly had the capacity to do that.
And so what I'm illustrating there is that by the time he gets all that equipment going through his own system, his cash flow is not changed one iota. It's where did it go to? It went to his benefit. Look at the fifth illustration, the last illustration there.
Yes.
And what's his cash value at that point? 3.5 million?
3,518,411.
Well, what was it when the insurance company handled it on its own?
It was much less than that.
So
that's correct.
He made $2 million tax free just by shopping at home. It was the same cash flow. But he had to go through that 4 years of capitalization in order to do that. Well, he can actually start using the equipment faster than that, financing the truck faster than that. All you got to do is just look at illustration 2, the first time he financed one truck.
Yes.
At the end of 2 years, what's his cash value?
At the end of the second year, it is $65,282.
Okay, well, what does the financing package consist of?
Principal and interest.
Yeah, but what does the amount?
$52,600.
That's less than the other number, isn't it?
Yes.
He could actually finance one truck at the end of 2 years, couldn't he?
Yes.
Yes, but he can also improve upon that, can't he? He just simply buys a policy and has it backdated 6 months. That means at 18 months, and now he can actually be financing the first truck. And the earlier you start with the policy, the longer it's enforced, the better it gets. See, this is a time probably that we ought to introduce the idea that you need a place to put windfall money. I don't care who you are. In all probability, a windfall of some kind is coming in the future that you don't know about.
Right.
Well, when a windfall comes along, what happens to the mind of the usual person out there?
Spend it.
Yes. All right. So we had a big Powerball winner here the other day, right?
Yes.
Have you ever studied the lives of people who win those things?
Yes.
Worst thing that ever happened to them, they say. Yeah. It's not good at all.
Right.
All because of the mindset that exists out there big time. All right, so years ago, and Carlos has been fascinated by this particular story, and he was recalling it the other day that he'd been repeating this several times, and he says, go over this again because I want to make sure I'm not exaggerating or whatever. That, out here on Highway 31, about 5-6 miles south, there's a piece of property there, 7.5 acres, that bought in a partnership. And at the same time, I bought a significant life insurance policy. Now, the reason I bought the policy was to put money in that I could borrow to pay off the snakes and dragons at the bank. Well, I knew that property would sell one of these days.
Okay.
I mean, it couldn't miss because so much is moving that direction. 13 years down the road, it's sold, and it was a nice chunk of change. Of course, we had to divide it up, but still, mine was nice. Now, that policy that I'd bought, I had been borrowing to pay the premiums about what it amounts to, really. It was actually another transaction. I put the money in and borrowed and paid off to the banks and such. But the net effect is the same if I just used dividends to pay premiums, that's all.
Okay.
All right, that meant I had a significant debt, didn't I?
Yes.
Well, guess what I did with that windfall?
You put it back.
Paid off the policy.
Right.
The loan.
You replenished your system.
Yes. Now, do you know that's the same thing as buying a policy today and backdating it 13 years?
Wow.
That's the same effect.
Right.
See, the earlier you start with a policy, the longer it's enforced, the more efficient it gets. Now, to dramatize that, if you go to page 71 through 74, there's the intergenerational thing there. So go to page 74. I want you to look at the fact that the grandparents put $2,000 a year in that policy for 22 years, and that with loans paid the premiums. Well, go to the last page of the illustration. That's page 74.
$1,689,344.
That's a pretty good difference, isn't it?
Yes.
Same input. same input. See, if you'd waited 13 years to crank up the policy, that's the difference. So the earlier you put money into a policy, the better. And you need to create a strategy to have a place. Is that brother made the same mistake that so many other folks, that clients of mine and people that I just observed, they never taught their wives how to be a widow. Now, loss of a spouse is pretty high on the stress factor scale. That's number one. Loss of a spouse or divorce is number one. That's bad, but when you leave a whole lot of other financial things that are not tied up neatly and whatnot, why you want to add to that stress? So on my way home, I told Mary, when I get home, I'm going to start teaching you how to be a widow. And so I took all the policies that she owns on me, plus the 4 small ones that I own on myself that's coming to her, plus fringe benefit stuff and so forth. And she's going to be getting about 1.75 million from that particular source. Well, I noticed that thinking the way life insurance folks think, to say I was still a prisoner of that. What advice shall I give to Mary to do with that? Well, my first instinct was to leave it on. Okay, I looked at the deposit option only with option to withdraw, and they were all guaranteed 3%, except for a couple of them was 4%. I said, well, baby, just leave them on deposit for that guarantee. So you got a guaranteed income there. Let's just take that 1.725. Let's just round off the fact that you're 3 years younger than I am, Mary, and you're going to live forever anyway. 1.5 million of that at least is going to go to the 3 children. From that particular source, we're talking about $45,000 a year, but from interest. Well, that's going to be taxable. Well, you're giving away $15,000 a year. Well, I don't think that's smart. So it finally dawned on me, look, I see, you learn things as time goes by.
Right, right.
I saw that, my word, that's stupid. Why don't we do this? And I researched it thoroughly, that upon my demise, Mary, Barry, Kim, and Deb, $500,000 each. She has income from other sources and so forth. She can live very well. You don't need that doggone money. And we've avoided paying $15,000 a year to the tax folks or whatnot. Now, there's no mortgage here. There's no mortgage there and so forth. All the cars, so forth, there's no loans there except in-house, whatever. Well, there's a place Kim and Dave can dump some of that money.
Right.
Right.
Understood.
All right. Now, the bad effect is that Debbie, they don't have a place to put that money. They see she's married to a lawyer, and lawyers think differently.
Isn't that the truth?
Yeah. See, they should have bought something years ago, somewhere along the way. Now, they've done a good job.
Okay.
But they should have bought a whole lot more and deliberately caused a place to put that windfall money. But is this taught in life insurance companies?
No.
Absolutely not. They don't think this way. But is it true?
Yes.
Oh, I rest my case.
What's the lead up again into the Martian story? Self-insuring against a total loss.
Right. So I tell Terry there, go back to the equipment financing page.
Okay.
The narrative part. And tell me what occupies approximately 1/3 of the page.
Number 4.
What is it?
Insurance.
What kind of insurance?
Property and casualty.
Yes. Not liability.
Right.
Not liability insurance.
Right.
Comprehensive and collision insurance. And so I asked group, have you ever seen a logging truck in the body shop? It doesn't happen.
Right.
Well, it can happen, but what does the first word of that paragraph, Richard?
Required.
Well, what does required mean as it relates to this page here? If you're going to get this financing, you have got to buy comprehensive and collision to protect us in case of loss of damage to the property that we are financing.
Right.
Terry, what are you having to pay for comprehensive and collision? And so I asked him. And I said, now we got to multiply that by 4 because you got 4 trucks or whatnot. Now, that's a lot of money paid out there for something that will probably never happen.
Right.
All right, now that's our background from which to work. Now let's go to illustration 5. It's about $300,000.
Yeah, $365,675.
$365,000.
That's age 41,
Okay.
start of
Now
year
let's
12.
say that up to that,
He can self-insure now.
yeah, he could self-insure at that point.
Yeah.
So I tell people, suppose that the Martians come one night in their spaceship, and there's a couple of guys in there, and they have never seen a logging truck in their life. They have no earthly idea what that is. And they have those ray guns. We don't stand a chance against a Martian. It's impossible. They've got stuff we don't have. One of them sees that logging truck there of Terry's and says, what in the world is that? Zap! Terry goes out there the next day, and there's a molten puddle of rubber and metal. Now, that qualifies for the definition of a total loss. All he's got to do, Jason, is call you and say, Terry, you ain't going to believe this, but the Martians got one of my trucks last night. Send me some money to replace it. Now, you know that really is complicated, isn't it? You don't have to fill out any Mickey Mouse paperwork or anything.
Right.
Mm-hmm. Now, can't you tell that life insurance company to send that money directly to your Gopher bank that you use to run your cash through?
Yes.
To send that electronically so that you don't have to mess with it?
Yes.
Yeah.
This is ridiculously simple.
That's what they say.
Once you know how.
Yes. If he's going to self-insure, he's playing honest insurance man, honest banker rather. He's playing honest banker, right?
Right.
Now, if you're going to play honest insurance man, don't you need to buy another policy for that particular purpose?
Yeah.
All right, so your job is to compute the premium. So what was he paying?
What was he paying in premium?
What was he paying in premiums for the comprehensive and collision?
$2,500 a year
Yeah,
per truck.
$10,000 a year.
Right.
Yeah. Okay. Well, what should be the premium on this new policy then?
At least $10,000.
The very same.
Well, why not 12?
Yeah.
Yeah. Can you overcapitalize?
Yeah. And what happens? The more capital you put in,
Yeah.
the more capital you get
So
out.
we've improved upon his total situation, haven't we?
Yes.